Hi, Chris here. What I'm going to show you is now a nice and very easy way to see where we are in the markets, kind of get the health of the market trend, and of course the direction the market is going to be in the future. And it's a simple idea that is called sector rotation. So the idea behind sector rotation is that in certain stages of markets, certain stocks will lead and certain sectors will lag. So sector rotation, that's going to be the title of this. And just to name a few, we'll say in mid and early bull markets, our leaders are, well, basically money flows into risk. So leaders are they're tech, they're discretionary, retail, and I'm not talking like Walmart retail. I'm talking like Abercrombie and Fitch or Gucci retail, that kind of thing. So we got retail, and another one would be like travel, hospitality, that sort of thing. And we can usually just get an idea of what these are with their ETF. So the tech ETF is XLK. The discretionary one is XLY, and the retail, I don't think there is an actual ETF for it in the spiders, but XLY normally includes some retail. Okay, so we have those two. And then in bear markets and in late bull markets, you're going like in early contraction time. So in early bears, you will find that utilities, if interest rates are low, utilities will lead, healthcare, and staples. Now that's not like the actual store. I'm talking like your Walmarts, your Procter and Gamble's, your Johnson and Johnson, your toilet paper makers. That's normally what I say, like staples like that, and like tobacco industries, things that generally don't have fluctuating demands, aren't really cyclical at all. Okay, so the actual ETFs that we use for these, utilities is XLU, healthcare is XLV, and consumer staples is XLP. So the idea is if we see that XLP, XLV, and XLU are leading the market and XLK and XLY are lagging the market, that means that the economy is starting to go into a contraction. And it's pretty objective because you don't need to make like some normative judgment about like unemployment, that kind of thing. You can see that money is flowing to safety, and that normally precedes a bear market. And if you see XLK and XLY leading, or like even small caps leading, these different things, then that means you're probably going into a very strong bull market. Okay, so let's take a look at the current conditions. So we have XLY, we have XLP, we have XLU, XLV, XLY, and XLK. Okay, so first thing that we're going to do is the simplest one is just to do a ratio chart of XLP to XLY. This gives us the most crude and basic measure that is still useful to see where money's actually going. So XLP divided by XLY. Okay, you see that the consumer staples, they were doing pretty darn well back in, let's see, we had them doing well in 2011 once the market topped and started going sideways. We had them well into the October 4th bottom, and then we had them doing very well ever since the May 1st top. So we can basically say right now, yes, once again, consumer staples are outperforming consumer discretionary. And you can just draw a trend line, say, okay, we have a break right there, it's a confirmed uptrend, that sort of thing. Just like when we were over here, we could say, okay, we have a break, it's a confirmed downtrend now, so we should take money out of XLP and put it into XLY, or that sort of thing. So money should be in XLP right now. Now, if I do the same exact thing and I put it up against XLK, it'll look slightly different. So XLK it looks slightly different, but the thing to notice, and I was actually doing some research earlier, that XLK itself is, like, tech should have topped long ago, but it didn't. Why? Apple. Of course, Apple. If you actually took XLK and you took their returns for the year, and then you took out Apple, you would find that instead of this 7% return from the beginning of the year, you would actually have only a 3% return. So, yes, tech is kind of skewed, but still, it gives you the same idea. So, with staples and utilities all making new highs, and healthcare making new highs, and like technology not being able to make new highs, and like having consumer discretionary make lower highs, yeah, we might be headed for an economic contraction, but that's how you do it. All right, thanks.